Welcome back, everybody. It's almost a quarter to the top of the hour. More like 18 minutes to the top of the hour. I'm Louisa Boyes, and we are just getting dug into the technicals at this moment in time. Richard Moorish joins me out of Zurich, a technical analyst, to look at things from a slightly different perspective, namely the ones with the lines and the dashes and where we should be putting our money based on those forecasts. Richard, let's start with the forex markets and with the Aussie dollar versus the US dollar. There are those who say that we could be looking at the Australian Central Bank slashing rates considerably by as much as 100 basis points tomorrow. Is that factored into your charts?
I think, Louisa, the very interesting thing that we're actually seeing with the Australian market is we've been building, if we have a look at the weekly chart which we've brought to you, you'll see there's a big bear flag that's been building on the market on the weeklies, which is very clear to see. It's not so clear on the dailies, but it's sitting there. If the market closes on a weekly basis below 0.6340, then this market is going to trigger this bear flag and it will activate the market for a very serious slump to the downside. On the daily patterning, we need to see the market go through the 61.05 level, and if we break that, then we look for the market to stop some point around 50, 65, 60, 68 for the market to finalise and make a base around there. This is very, very common when you see, and it's a good reflection of fractured credit markets, because it stops the commodity prices go up, but the mining companies themselves start to see a lot of contraction of capacity, and this actually destroys the actual commodity forex prices. This is what I think we're starting to see now appear in the Australian dollar. We'll cover gold a bit later, and we'll see the other part of that.
Sticking to the theme of the currencies, sterling today got a whack over its head after the data, first and foremost, but also the broader worries about the Bank of England once again potentially having to cut rates on Thursday. Again, your charts.
Yeah, I think the answer here is all this market has done is a test down to the 135 level, which was one of our first early part of the year targets. The market made it. We're doing the retest. It looks like the market's completed that. It's done what is quite usual, which is a run up to a weekend where the bears get squeezed out. We look suddenly very positive, and the next thing that you see is that come the following week the market gets crushed. We had a signal some weeks back at 41.18 where the market broke against a GAN point and a harmonic, which turned around and said this market is in serious problems, and all we're seeing is correction. We believe we're now back on the way down to 135. We'll probably break that this time round, and we're looking for the market to go to 125.67. Around that point we would expect the market to try and make a base. It would be the right level for the market to make a base, but then that's only to retest the 135 level. The market would have to consolidate between 25.67, 135. If it fails that, then we'll be looking for parity and beyond going ahead for sterling. Not looking very good for sterling overall looking into the future.
70% of global gold demand comes from India alone. I mean, that's a staggering figure, and it's even more staggering when you then look at the fall in Indian imports, falling by 90% during the month of January, year on year, and yet gold is kind of shrugging these numbers off.
Yeah, I think this again is part of what we're arguing on fractured credit markets. We're in the second phase of a fractured credit market. What you normally see is you see the commodity prices start to accelerate to the top side again and be pushing very important levels. It's important for this market, if it can break over 929 this week, then we'd expect those highs at 1028 to get removed. In fractured credit markets, what you find is that as the production is reduced, therefore it actually creates this run to safe haven of the US dollar, which then creates a bit of a demand also into the gold prices. We're also seeing a fall off in risk premium in every asset class at the moment. There is really none out there. The government bond safe haven has got no risk premium in it. Equity markets have really still not got any risk premium in them. And as such, it's natural that people will start shifting into gold. We see the highs getting taken, and we see them going up to around 1,393. The important thing to work out, this is pattern replication, very similar to what we saw the back end of 2005, and if the market actually sits here and we actually do the breakout, it will be a continuation bull market.
Yeah.
The setback will be very limited.
Richard, thank you for being with us. Richard Moorish, live out of Zurich.